On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
I can't believe it's Friday afternoon again already. No, actually I can, because I've been away for a little while and I've missed a couple of Fridays. But it's time for me to welcome to the studio once again from Envision Financial, Luke Smith. Good afternoon.
Mate, good to see you back.
Well, I had a great time while I was away, and I'm sure you had a great time while I was away too.
Yeah, I was at work. It was wonderful. Thoroughly enjoyable.
This weekend, of course, tomorrow, as a matter of fact, it's the federal election. And I know that there's been a lot of talk about cost of living and housing crisis and lots of things, but there's been very little focus on an issue relating to superannuation that some people are concerned about. And the government currently has a policy where they want to introduce the taxation of unrealised capital gains in your super fund if you are perceived to have too much money in your fund. Now, what they've said is it will only affect a very small number of people, but the problem with that is that if it passes, then that's the thin edge of the wedge, isn't it? If they get away with that, they'll start taxing unrealised gains elsewhere as well, won't they? Yeah,
look, exactly right. And the 3 million threshold per person has been thrown up for quite a while, and it's never really got a lot of momentum because of the proportion of people that it would actually target. But you're right. I think anybody that could propose the tax on an unrealised asset where somebody hasn't realised the benefit, I think that's financial lunacy. And if something like that was to get momentum and be applied to investment properties, your primary residence, I've heard it thrown around for that as well. I just think it's absolutely disgusting policy and a real reflection of the disconnection between your so-called average person at any end of the spectrum financially. It would be something that would punish the vast majority of the country. While
the current policy is directly aimed at high wealth individuals, the basic principle is just fundamentally wrong. Taxing unrealised gains will actually force people to sell, even if they don't want to.
That's right. And then you'll be talking about the impact from a cash flow perspective. You'll be talking then about forcing people to not improve the value of properties, because if it leaked into, personal assets or assets owned in other vehicles, when you think about the potential for where that could go, you'd have nobody spending any money on properties. You then have an increase in the defective nature of most dwellings. All of the legislation in the ACT now is written for the renter. It's actually not written for the owner, and I think there's no incentive to own an investment property in the ACT anymore because of the way that the legislation has been written. And I know I have clients coming in all the time offloading properties, and they all have the same frustration between land tax rates and everything else that goes on, and the lack of control you have over the asset you are holding.
Yeah.
Everything is against you as the person that's carrying the risk, and that's not what legislation should be written for. Legislation should be written to protect the people that are taking the risks, not the people that are benefiting from them.
You've sort of gone off on a little bit of a tangent there, but I want to come back to the unrealised gains aspect, because there's another element to that. A lot of people that are operating farms, rural properties, they have their farm property perhaps tied up in their self-managed super fund, and they could very well fall foul of this and be forced to sell the family farm.
Yeah, look, and it's a generational problem for a lot of large landholders, because historically, the value of the farm in the majority of instances is the capital value of the land, and you'll have good years and bad years in relation to production of what you're cropping or what you're growing, what you're feeding, what you're using the land for. And you're exactly right. You have very, very asset-rich families, and from a generational perspective, it's becoming more and more of a problem, because you've got a younger generation. A lot of them don't want to do the hard work because young kids can't work hard anymore. And they also don't have the resources or access to the capital to be able to pay mum and dad out the market value of the land. So if you were to bring a tax in like that, you could actually destroy intergenerational assets. And with the way the money's being spent at the moment, I don't think it's a good reflection or incentive for anybody to really work hard, which then now we're back to giving out ribbons to everybody, aren't we?
All right, we do actually have a topic today which is not related to the matters we've discussed so far. Today's topic is misconceptions about merging your super into a single fund.
Yeah.
And I know that a lot of people have actually been encouraged to do this because it makes sense to track down any lost super accounts that you might have lost track of over the years, and avoid paying multiple fees, because if every single fund, they'll all be charging you fees. If you put them in the one fund, surely that's going to save you money.
Well, maybe.
Maybe. All right.
And I think that's where we need to come at this, because it's not a hard and fast one is better than two. And the misconception there is that, well, there are less fees. But if you've got twice the price of or twice the value of a fund and you're charged on the value of the fund, by rights, it's not going to be that different.
Okay.
And what I mean by that is if you've got two funds with 50 grand in them and you're paying 0.5% on the ICR, which is the internal cost ratio, and you put them together and have $100,000 paying a similar fee, there isn't a lot of net benefit. And a lot of the industry funds and the simple superannuation structures have a very low admin fee, because that's very appealing to people, because that's generally the uninformed measure of value or cost of using a structure. So be careful that, one, you're not just going to go and replicate the same problem in a single fund. Mm-hmm. Two, think about the cost and the implications of moving, because if you hold significant assets in a fund and you want to merge, you need to sell those assets down, which could trigger a capital gain inside your fund, which I can assure you that if there's a capital gain involved on a significant asset base to merge them for the purpose of having one location, the capital gains tax cost will outweigh any admin saving of going from two funds to one fund. So check that out before you do it. If you have a very large taxable component in one of your funds and you want to merge them, be very, very careful, because what you are doing is you're making it, or you're diluting your capacity to fix your taxable component inside your fund. So that we've talked about on a number of occasions in previous shows in relation to death tax in super, and that's what I'm talking about. I'm talking about the 17% liability that adult children incur when they receive money from parents out of super. And if you push two funds together and you muddy taxable and tax-free component in the same fund, there are strategies to try and avoid that tax, but you dilute your capacity to fix it if you took $50,000 of taxable and $50,000 of tax-free. If you merge them together, it's a lot harder to fix that tax problem in the future. So again, think about the broader tax strategy that you're trying to address, and think about the costs that may not be associated with the running fees of a fund, because I can assure you that 17% on a taxable component is going to be far, far more than a $7 a month admin fee you're going to save by merging accounts, because that is a much bigger problem than people realise. And when they actually sit down and do the numbers, they're quite shocked to see the implications. And if you merge a fund like that and put two into one, it can take a significant amount of time to try and unwrap those tax problems. So be very mindful of that, because it's a much bigger problem than people realise.
Okay, but if you reduce the number of funds that you're operating, surely that makes it easier to manage them, doesn't it?
Possibly. Again, it depends on why you're moving funds. You might have a fund on the left here that gives you a really broad amount of control and choice, and you might be rolling them together because this fund over here has a lower admin fee, but you've only got 5 investment options. So if you want to hold ETFs or listed shares or converting preference shares or whatever it is that you want to hold, check and see where you're going, because not all funds have the same investment menu or approved product list. And that's the suite of investments that you can select from. They can vary significantly from fund to fund, just like the insurance options. Another reason why I would be very hesitant for people to blindly push super funds together is if you have insurance that you've held through a fund, and let's call that Fund A, and you merge into Fund B, you will by default lose the insurance that is in that fund. Now, for occupational reasons or medical reasons, if you are uninsurable and you roll over to a new fund and try and get new insurance, you could be very, very upset about the outcome. And I would preface the automatic rollover of two funds where insurance is in play. If you are going to move, get new insurance in the fund you're going to first, And then when you roll over, you know that you have a policy in place that can protect you from a lump sum or an income perspective. But do not roll over a fund that you have insurance through without knowing the consequences on the other side of the fence, because that could be catastrophic from a capital perspective, because you may not be able to get what you had in the new fund. And once it's gone forever. So again, don't assume that putting two into one is better. You need to think about why you're doing it and the implications from a strategic perspective.
Are there any other circumstances or reasons where it might actually be better to maintain two or more funds instead of just one?
Yeah, so also the eligible start date of a fund when it comes to potentially a TPD claim, that can have an impact over the taxable and tax-free calculation if you were to receive a benefit on that front. Also, the use of legislation. So take, for example, the PSS. So the PSS does not allow you to take advantage of the transition to retirement legislation. And if you had money from another fund and you roll it in there, it sits in the PSS as what's called a transfer amount. Now, because the PSS does not allow you to use the transition to retirement legislation, you could have a significant balance sitting in that transfer amount bucket. And if it was rolled out to another fund, you would be able to access potentially up to 10% of the balance under the transition to retirement rules while still contributing to that employer fund at the same time. So that for me has massive significance when it comes to the accessibility of funds and the legislation that you could potentially take advantage of. So again, the assumption that one is better isn't always the case, and people need to dig a little deeper and sort of identify why first, and then look at the ancillary problems that it could cause, because taking advantage of those pieces of legislation are very, very powerful. I would also consider from an estate perspective, if you wanted to manage the disbursement of your assets and you have a blended family or you have multiple children of varying ages, some dependent, some not, it's a great way to have more secure ways to disperse money, because you may or may not be able to use a binding nomination. You can for minors. You may not be able to for adult children. You might need to then have it go into your estate. If it goes into your estate, it could be challenged. So again, some really good estate planning advice is recommended where you are thinking about the disbursement of assets. And if it's all mushed into one fund, you could jeopardize the clarity of your wishes and the execution of your wishes. So think about, well, what is this capital for? Okay, that's for that child. You might have fund over here for 3 other kids. You might have part of a fund go to a spouse. There could be a range of reasons that you would hold more than one fund from an estate planning perspective. And I've even seen where multiple self-managed super funds have been run in specific situations. But again, don't assume that one is better, because you could actually be causing massive costs and time and fighting and legals and all sorts of other expenses that you haven't factored in by just banging them into one account.
Luke Smith from Envision Financial is with me in the studio today, and we're talking about misconceptions around merging all of your super into a single location, and it's starting to sound like there are a lot of those misconceptions.
Oh, loads.
We'll explore the topic a little bit more in just a moment on 2CC. Luke Smith from Envision Financial is with me in the studio this afternoon, and we're talking about misconceptions about merging all of your super into a single location. So, Luke, we've covered a lot of territory so far today, but what are the key things that people need to keep in mind?
Well, one, I think, remember that not all funds are the same. They have different insurance options, they have different costs, they have different investment menus, and you want to make sure that the fund will allow you to use the legislation that's appropriate for you. And we touched on before the ad break, the transition to retirement legislation is a great example of that. Some funds out there still do not have a pension capacity. So make sure that you understand what the features are of the fund that you're going to. Consider the investment menu of the fund you are going to move to, and see if there really is a cost saving, and then weigh up, depending on the type of fund you're in, weigh up the implications in relation to the potential capital gain on the sale of assets to move over, and also the time that you could be out of the market because we saw a couple of weeks ago when Donald was in full flight that we were having 4, 5, 6, 7, 10% swings on a daily basis. Now, with a significant sum, that could be quite expensive, and again, will outweigh any annual fee saving or perceived fee saving by merging accounts. If you have insurance in a fund, make sure that you either don't need it or you can get new cover in the fund that you're going to, because there is nothing in the legislation that says that you can't have multiple super funds. There's also nothing in the legislation that says that you can't have a super fund and not add money to it. And I find those types of misconceptions become very prevalent in conversations. Oh, I can't open another fund because my employer doesn't add to that one. That's cool. No problems. No one said they had to. You can even split your employer contributions into multiple funds, because if you do have insurance, it's very handy to have potentially some money coming in, or you'll need to notify the fund of your intention to keep it. Because another wonderful government initiative a couple of years ago was that if you haven't put money into a fund in 16 months, we'll cancel your insurance by default, because we'll work on the premise that cheaper is better. Now, I don't know if they've been sued for that, but I've seen a number of instances in real life where that's caused a massive problem because somebody's moved house, hasn't notified a fund of a change of address, forgot they had the fund, lost it, which happens more often than you realise, and then insurance is lost and the person may be medically uninsurable. And it was because of the assumption that cheaper is better that people have now suffered significant capital loss. So make sure you understand why you're moving. Make sure you understand the tax implications, the feature implications, and also that you can use legislation, because it's not always the best thing to do. And if estate planning is part of your broader strategy and you've got really good advice in that field, using multiple funds can be a great way to try and reduce challenges and estate issues. So think about the purpose, not the potential cost, because I can assure you again that the legal fees to unwrap something that is muddy will be far, far more than the cost of running a couple of different funds for specific purposes, for specific children, et cetera, et cetera. So don't just bang them together and think it's better. They're not always the cupcakes and rainbows you're aiming for.
No, I get the impression that the key takeout here is that there may be unanticipated costs that are greater than any savings benefit that you might achieve.
Totally. And I guess that's what I want people to take from today is don't assume that one is better than two, because you could be costing yourself a fortune depending on the type of fund you have and the implications of moving from one to another.
So, Luke, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. That's Envision with an E. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. And we have Envision Financial Canberra on YouTube, where we have a backlog of all of our shows. So you can watch those on your phone and subscribe to that and get notified of our latest releases. And all of these types of strategies and cost analysis discussions are in Smart Money Strategy, your ultimate guide to financial planning, available in all good and bad bookstores.
Yes, indeed, as well as online.
True.
Absolutely. Luke
Very
Smith
true.
from Envision Financial. Thanks very much.
See you next week.
Back again next Friday afternoon at the same time right here on Radio 2CC.